Joining us right now is Alexandra Wilson-Elizondo, Deputy CIO of Multi-Asset Solutions at Goldman Sachs Asset Management. I don't know if you had an opportunity to hear what Mr. Druckenmiller had to say. He thinks that it's going to be tough sledding, basically, unless you're an individual stock picker. Are you in the same place?
We think that it's going to be a little bit more difficult of an environment, but that there's plenty of opportunity to build long-lasting, good portfolios. And like right now, we're in the middle of our alternative summit, and we're just really excited to see people saying that they're going to keep consistency with their private allocations, and that when you're expecting the unexpected, it's a great place to be to, provide returns, give you diversification, and deal somewhat with a more difficult environment.
So the question I was going to ask, though, is when you look at the private allocations right now, how much of that is becoming a credit business versus an equities business?
I mean, it really is up to the individual investor. But right now, there's plenty of opportunity within private equity.
Right.
Oftentimes throughout the cycle, in fact, it can be acyclical because you can go in and you can control the company. You can figure out ways to really extract value. But private credit's also very attractive.
Do you believe that actually the private markets right now and still are significantly outperforming the public markets? Generally speaking. I mean, that's always been the argument. But the truth is, after fees and everything else, it becomes a little bit more complicated.
It's fair. It's very complicated, but I think that's why the manager you select is really important.
No, when I say complicated to actually really judge and measure whether your performance, whether you would have been better, just sitting in the S&P the whole time.
Well, that is a very fair question, and I think liquidity is very important when you're looking at markets. And, privates aren't going to detract from needing to have public market liquidity. And, look at this year. Being in stocks was a fantastic trade.
No, I was just, when you say and highlight the benefits of alternative markets, it just sounds like, it's like non-correlated assets sometimes are important.
But are they really non-correlated, or are they just not marked?
It'd be nice to have one, but if you do really want something non-correlated, it means you don't want to be correlated with what's going on everywhere else. And I think that's the undertone I'm hearing from you. And we just, maybe because now I'm thinking about multiples, given all the problems in the world. I mean, 20 times earnings is not cheap, and we have major issues to be thinking about right now.
So I think it's fair to say that it's not cheap when you're looking at, the broad market holistically, but when you lift the hood, actually the bulk of stocks are around 15 times, which is about average.
Okay. It's the Magnificent Seven that skew everything, or it's a story stocks that have us at 20.
Effectively, I mean, the CIO of equities always says to me, the S&P is not the market. Right?
The S&P may not be the market, but the question is, but I want to go back to the marking question.
Yeah.
Because a lot of people, this goes back to the larger issue about the performance. It looks good. Privates always look good on a relative basis to the public markets most of the time because of the way they're marked.
I don't necessarily think it's because of the way they're marked. I mean, and sometimes you're actually getting really good returns. You get to, the whole concept of being private is there's customization in there. You get to determine the underwriting and what you're getting back.
We're going to hear from the Fed later today. What are you expecting to hear about? What is the signal? What is like the sentence that you're focused on?
I don't think there's a singular sentence, but what I will say is the Fed is looking for a rate to be at for a long period of time. And when you think about, we had gangbusters GDP, we had core PCE that came in okay, but yesterday we had an ECI number that was meaningfully hot. There is a tension that's building between financial stability and the wage price spiral that I think is uncomfortable. And I think they want to signal to the market, we're happy to be here, but oh, by the way, we have the free option of the December hike, and we're going to keep it.
And you think they're going to take it?
Take the December?
Yeah.
I think that if the data comes through hotter than expected, then yes. And we've got some important numbers on Friday. So if the wage dynamics continue and you continue to see, better than expected data come through, then yes.